to pick their brains about how the Reg A space is evolving, what you need to know as an entrepreneur trying to navigate raising in the Reg A space, and understand when this path can make sense for you. I can tell you from Kingscrowd data that over the first 9 months of 2025, we have seen $448 million raised across 215 Reg A deals, including some of the largest Reg A's in the history of the industry. And by the way, these numbers only focus on private equity issuers that Kingscrowd tracks. This does not include all of the fractional and real estate issuers out there as well, which would bring this number up even much higher. You may have seen that Picasso, a real estate tech platform, just closed on a $70 million Reg A in funds, and Newsmax had one of the most prominent Reg A's in recent history, bringing this space to the forefront. Put simply, the Reg A space is maturing and becoming a powerful way for later stage companies to raise significant growth capital as well as prepare their businesses to go public. So I'm excited to have Andrew Stevenson and Stormer Santana here. Before we kick this off, I just want to say one thing to the crowd. Well, actually, two things. One, for all of you who are listening, feel free to drop your questions into the Q&A section, and we'll work to get to as many of them before the top of the hour. And second, if you stick around for the entire session, one person that is sticking around by the end of the session will be rewarded a 3-month free Edge membership that we will announce at the end of the session at random based on who is still here. So definitely stick around because you don't want to miss out on an opportunity to get a free Edge membership, including if you are an Edge member, you will not have to pay for the next 3 months. So with that, let's get on to the show. Andrew and Stormer, thanks for being here. Appreciate it.
Thanks, Chris. Thanks
for having us.
Absolutely. So let's kick it off. Stormer, give us a little bit on your background in the industry and what you do at Dalmore Group, and then Andrew, I'll throw it over to you.
Yeah, of course. Well, appreciate it, Chris. Really excited to be here. By way of background, my name is Stormer Santana. I lead sales at Dalmore Group. Dalmore, we've been a broker-dealer for 20 years, hyper-focused in online fundraising, supporting issuers across Regulation CF, Regulation A, and of course, Regulation D. About 1,000 offerings supported, $3 billion in capital raised, and our company's today raising anywhere from $60 to $100 million a month across these various exemptions. And we've really positioned ourselves as this tech-enabled broker-dealer, allowing our issuers to go to market in a white-labeled solution, build the tools that they need to raise capital from their community, and we're seeing a lot of success from it. So really excited to dive into the space today.
Phenomenal. And Andrew, tell us a little bit about yourself.
Hey there, I'm Andrew Stevenson, as Chris mentioned, Chief Product Officer with CrowdCheck. I've been also a partner with CrowdCheck Law, which are so our law firm that we kind of started up to go along with the work that we were doing with CrowdCheck. So I've been with CrowdCheck since 2013. So we're kind of early on in the space following enactment of the Jobs Act. So kind of been seeing the space develop as it's grown and through the rulemaking processes to getting to the point where companies have been able to take advantage of the rules and see some successes raising funds.
Thanks, Andrew. And for those who don't know, this year, Kingscrowd did acquire CrowdCheck. We run it under our Kingscrowd Advisory subsidiary. And what I have always loved and respected about CrowdCheck is that they have been one of the longest standing players in our industry. They've qualified, I think, over 250 or 240 Reg A's to date. They've done some pretty incredible work in the space and have really been pioneers in helping founders be able to raise in this way and get set and ready to do a Reg A offering. So for the founders who are out there, something that I want to do today is not scare you away from Reg A, but to provide a realistic view of Regulation A and all that it entails. And so with that in mind, I'm going to throw it over to Andrew to talk a little bit about what does the kind of form filing legal process look like? And perhaps you can be clear about how it differs from a regulation crowdfunding offering that they may be more aware of. What goes into it that makes it much more intensive?
Yeah, absolutely. It's interesting, sort of kind of early on, it was some of the the crowdfunding kind of boosters who first started referring to Regulation A as a mini IPO, just to try to sort of emphasize that, hey, we got to think of it more like a public offering in some way. At first, the SEC wasn't using that language, but recently they've been using that too. And so that's one way that companies should think about Regulation A. It is a stepping stone, or a sort of kind of an intermediate position of not you're not yet you're no longer sort of a private company, but you're not fully yet a public company. You're not to the level of doing all the things that are is done by companies that are sort of trading on the National Securities Exchange. But you've still got a lot more obligations, and those obligations begin as you're getting ready for that offering. It's not an overnight process. The companies will have to get ready for it. And the first thing is just making sure, are you eligible? Reg A being limited to sort of companies that are sort of organized and doing business either in the United States or Canada. So if your operations are primarily overseas, Reg A may not be a fit for you. You also have to look at your kind of the financial statements. Are you able to get audited financial statements? For companies that have one of the areas we see the most issues is companies that have inventory. Because if they have not previously taken steps to enable an audit of that, sort of to get their books in order for an audit, they may have to actually wait a full year because the auditing accountant just won't have information to be able to audit on that look back. Some companies will say, well, what about tier one? SEC doesn't require audit financial statements for tier one, and that's true, but it's a bit of a red herring. So Reg A comes in kind of two flavors. There's tier one and tier two. Tier one, you can think more about this is a state primarily about state registration versus tier two, which is primarily about federal SEC registration. And the majority of states require audited financial statements for that type of offering. So you're still going to have to do audit financial statements, but now you actually have a little bit more of a headache because you have to go through the state registration process. It limits how you can communicate to investors. And so if you're planning a campaign using that crowdfunding approach that company has shown to be successful, especially when you're trying to reach that broad market of investors across the entire country, tier two is the route you're going to go. It's more focused in that SEC registration process, but it does mean and you don't have any of those hiccups with the state filings. Also, things to think about for a company when we're getting started. What are you going to sell to investors? That's a key consideration. Is it going to be and some of that thinking is well, what does your capital stack look like right now? Are you just common stock? Have you already done some preferred stocks? And then where do you want these investors to fit into that? It also needs to think about, well, what are the future plans? Do you want to use this as a stepping stone to really being a public company in the future? Well, maybe stick with common stock, something that is going to be that would be the class of security that would trade in the future when you get to that point. Or if it's something maybe you realize, hey, we don't think we're getting a lot of investor interest unless we do something, unless we give a preference, and you could consider a preferred stock. But all in all, those are kind of those initial questions to think about and plan for, because it is a process, and so it usually ends up being a few months, even before that initial filing with the SEC. Once filed with the SEC, now you're into that review process. So the SEC, they do review Reg A offerings just like they review IPOs. So you're going into the office with the same examiners. They'll look at your filing, make sure everything's complete. They're often going to come back with comments. First round of comments usually comes in about 30 days. Companies will go through the process of amending their filings, preparing a response and resubmitting. The second round of review goes a little bit more quickly, but there'll often be more comments. And then usually for most companies, we'll be able to clear the comments out in 2 letters. There may be some verbal comments that come after that, but that timeline and then the response it takes, it's usually you're probably looking at about 2 to 3 months once you're into that SEC review before going live. So if you consider the process to prepare and then the process of while in review the SEC, you have to plan for sort of kind of 4 to 6 months from kind of go until the offering will be live.
Yeah, and I want to be really clear about that. Thank you, Andrew. You're talking about a 4 to 6 month process. So if you think you need money in 6 months, you're probably already 6 months behind if you haven't started this process, right? It takes a lot of time to actually go live with a Regulation A offering. And that's because unlike Reg CF, where you literally just file your Form C and then, it basically gets accepted by the SEC system, right? Like, yes, you submitted this to the SEC. In this case with the Regulation A, you actually have to be qualified, and an examiner is going to dig into your deal, ask questions, and they have 30-day timelines to work on. So as soon as you file it with the SEC, now you're just sitting there for 30 days waiting just to hear from them. Then you're definitely going to hear from them, especially the first time around with questions, have to answer those, which could take another, 3 to 5 business days. And then you have to wait another 30 days typically before you'll hear from them again. And they could come back with more questions. So it's just, the first time I ever went through it, I was like, wait a second, what did I just get myself into? It could be a little
Yeah.
intimidating too, because you're literally getting a notice back from the SEC, them questioning things about your business. And it's just them examining the document and asking questions to provide more clarity to investors. But just know that you're going to be going into a fairly intensive process where there are people at the SEC paying attention. And this is not just because I want to do what I get to. You're going to have to answer those questions to the SEC first. And that is very different than Reg CF and can be intimidating.
Yeah, and you also consider sort of how that information can go stale during that process and during that process. So 3 months after the end of a fiscal year, company will now need new audited financial statements for the most recently completed year. 9 months after the end of the fiscal year, it'll need a 6 month interim audited financial statement. So there could be some points in the year if you're while you're still under review where the offering statement will need significant edits in order to incorporate that new information. So those are all things to kind of bear in mind and consider in that timeline. And so yeah, so we're doing this panel on October 2nd. We're kind of in the time of year though. We're sort of in the kind of the last, we're so kind of in the kind of last stretch of wanting to submit a new filing that you'd be able to do with sort of year end. So if your year end fiscal year end 23 and 24 audit financial statements and interim June 30, 25 financial statements, in order to be sure to you're clearing through the process and getting qualified prior to the end of March 2026 in order to be able to use those statements. As you're getting closer to the end of year, it may, yeah, and also they're human. The SEC, you're doing this is a human process with the SEC. So examiners go on vacation, they get swamped with emails, so they have other projects that they have to focus on. So sometimes, yeah, it can take longer because you have to deal with that and all. And so those are all things to bear in mind. It's not an overnight process.
100%. Which I think is a perfect lead in for Stormer. Stormer, I'd like to talk to you about, what types of companies does Regulation A make sense for? And I think we should talk about two specific things: what types of companies, and then there's also another type of issuer where this makes a lot of sense, right? And I'll let you get into it, talking about fractionals and things like that. But yeah, talk to us a little bit about, in your experience, what types of profile companies do you think makes most sense for this space?
Yeah, for sure. I appreciate it. And I think just like emphasize what Andrew mentioned, like building a team around you for a Regulation A prep is extremely important. And I think even as you're like starting to forecast your financing needs, understanding what the purpose of the Reg A offering looks like and why you're going about it. I speak with a lot of founders, and sometimes the rationale for Reg A is, hey, I've raised 10 million in the past, 5 million for a CF is too small for me. And I don't know if that's the notion, right? Because we're looking at 6 months, significant capital deployed, this review process, and you have to really think: is it worth waiting that time to potentially have your finances go stale, to have dry powder sitting there waiting for the opportunity to invest, when in fact you could launch a CF, maybe even a Reg D to complement things? So I always like to kind of position it with issuers, and I think that's one of the reasons Dalmore has been really successful in the Reg A space is we take like a very consultative approach to working with our issuers. We do that in very close combination with CrowdCheck because we've worked with a lot of deals together. I see an area where founders often go awry is they hire the most expensive, biggest name lawyer that they can possibly hire to support the Reg A. And my question is, have they done a Reg A before? Because once you get in that NOL process, that review process, having a team that understands the process, the timelines, the commitments, and can forecast can make this, this go to market a lot smoother, a lot quicker. And so having that broker dealer relationship, having a legal counsel team, that's where you can kind of build best in class to help you go live. So, when like looking at like who are best suited for a Regulation A, I always look at, okay, have you raised capital from the crowd before? Have you done a Reg CF or maybe another Reg A in the past? And if that hasn't taken place, my first question is, who are your investors? What does your community look like? Because the intent of a Regulation A is visibility and viability, allowing a large community of customers, fans, supporters, followers to participate in deals that hypothetically they couldn't if they were non-accredited. or excuse me, accredited. And so, with that, it's really crucial to think about your strategy when go to market, right? A Regulation A gives you this big opportunity to raise $75 million of capital. But once it's live, who's there to invest? And having that strategy in place, super, super critical. So if you're a startup looking to raise, $75 million or leverage Regulation A, I first think, okay, have you done a CF and have you built up an audience, an email list, a community of non-accredited investors that want to participate in an offering like this? And if so, great. Now you're on your way to building that kind of audience for that Reg A offering. Second thing is do you have dry powder on the side? Is there institutions or high net worth or family office that want to participate? And that's where Regulation D can be complementary. Having a side-by-side offering with a CF and a D can bridge that 6-month gap before that Regulation A is qualified. And I think that's super important to factor in, is that combination of Reg D to bring in any capital that's available. And so with that, if you've got the community, that's the most important thing. If the idea is, hey, I'm going to launch a Reg A and then it's only going to come from marketing, it's going to be a really, really expensive and challenging process. For one, marketing takes a long time to get warm. You're spending a lot of capital to bring in eyes to that offering. And, of course, it's important to have technology that gives you visibility into who's coming to your offering. And that's something that, Dalmore, we've been building really heavily as our tech platform, but also our data behind what's happening in a raise. So if an investor comes, that you see that transparency into a lead versus an investor with pixel tracking and whatnot. So that's kind of one idea, is building that roadmap, building that perfect team so that you've proven the model of crowdfunding and of retail community participation, so that your Reg A is perfectly tuned for momentum. So that's the one and done type of offering. The other perspective, which we see a lot of interest in today, are the perpetual issuers, the marketplaces, the funds, the family offices or institutions. These larger, capital raisers who typically leverage Regulation D, often 506C structure, they're looking at Regulation A as a way to broaden their community, right? They've raised hundreds of millions through Regulation D, maybe for a fund or their portfolios. Now they're looking at Regulation A as a way to kind of complement their entire investor suite, expand their investor audience, bring in smaller tickets, but larger investors. And if you can do that, you can really start to build the model where you can put out offerings in perpetuity and have a community continue to back you with that, kind of retail participation. So, that's kind of my perspective on how things are right now. Building a team of best in class, so important. And then ultimately having a strategy to go to market. Can't emphasize that enough.
No, I think that's right. And it is not uncommon for us to see that the companies that are coming to Regulation A have been through Reg CF before, have done maybe Reg D 506C where they've sold to accredited but online. People who have been through the process have built a community of retail investors. That's one side of it. And then the other side of it is those with deep pockets, right? Picasso is a very successful company with massive venture investors that's already valued at $1 billion. And they got 14,000 investors into their $70 million Reg A. But that's because they were willing to spend pretty deeply on marketing because they saw it as a two-pronged approach. They were going to raise capital and they were also going to get way more people that could buy into their fractional real estate platform. So they saw it as customer acquisition as well, and it was worth it for them to spend on that marketing. But if you're not coming with an audience, if you're not coming with the budget, I've seen people who think, well, Reg CF wasn't great for us, but we're going to do Reg A because we could raise up to 75 million. It's filing the paperwork does not make anyone more interested in your deal whatsoever. Right. You're just 6 months down the path and have spent way more money getting ready for the Reg A offering. So that is certainly not the way to go. Just talk to me a little bit about a couple examples, Stormer, of these serial issuers like Arrive, like what that actually looks like for those folks who are listening who maybe are interested in creating something like that. What type of examples do you have to share with them?
100%. So I think this is definitely a sweet spot for Dalmore. We've worked with dozens of marketplaces, platforms, fractional platforms, if you will, where the idea is you take an asset, maybe it's real estate, maybe it's a collectible, maybe it's an equestrian horse, with My Racehorse, for example, and break down those units into digestible pieces that retail can participate with. Now, what makes Reg A really unique and interesting is what's called the series structure. So you're filing one Regulation A offering for an aggregate of 75 million, but in theory, you can offer series of offerings within that Reg A. And so in the case of Arrived Homes, dozens of small single-family homes available to their community underneath that Regulation A offering. Now, what's really powerful for marketplaces, especially those that are starting out, and I tend to see like an upward trend of marketplaces that are looking to kind of get into the space. Maybe it's the tokenization that's kind of at the forefront, but the idea of like, we want to fractionalize an asset class, we want to go to market. Regulation A, super powerful. You launch one filing, maybe 6 months, some time with legal counsel and the SEC, but then you have the ability to launch series at your cadence to your community. Again, you have to have that community that's interested in participating. That's where having Reg D on the side to complement with larger checks can be really powerful. But what's really cool about Reg A is you start launching these smaller series to your community, you start filling them up one at a time, and now you're starting to build your audience, you're starting to build your community. And what's great is regulation securities can be tradable after the close of an offering, unlike Reg CF, which has a 1-year lockup period. So what I think is really cool about Arrived Homes, for example, they've got tons and tons of single family homes, investable opportunities for retail investors. They just recently opened up secondary trading to their community. Now, secondary trading is something where you've got your security, you've purchased, maybe you've purchased over the last few years. Now it's an opportunity to list that security and potentially have it bought or sold on an exchange. And these are exchanges that are hosted on the platform. So it's, again, full in control of the platform to have a community that's going to participate along secondary. And again, I have a lot of founders that come to us and like, we want to do a Reg A because we need to have secondary live. And I always say, well, let's raise the initial capital first. Let's focus on the deployment of the capital. Then we'll think about liquidity. And what Arrive's done, which I think is really strategic, is they've opened up small trading windows. So maybe like 1 month or few week trading windows, as opposed to like a perpetual trading opportunity. That's, I think, performed really well for them. They've seen a lot of volume. They, have that kind of pent up demand from investors. And that, truly gives you that mini IPO experience where you've sold to a very large audience of retail participants. And now there's some liquidity options to, move securities around and provide some flexibility for investors. So that's something we excel in. We really focus on secondary, and for those marketplaces that are looking to scale, that should definitely be part of your strategy long term.
I love that. And yeah, it just reiterating what you said, if you use an Arrived, a Finley, a Rally Road, any of these, a lot of them are using back-end Vestibles. They're using a back-end broker dealer who's actually managing, the regulatory side of things to make your life easy, to really focus on what you're good at, which is, finding that asset, being the sourcer of the asset, being the sourcer of investors, and not spending all your time on the regulatory front. And I think it's a really, really cool model. And I love seeing more people, instead of going and, becoming broker dealers themselves or becoming FINRA registered platforms in the CF space, saying, hey, we could partner up with someone like a Dalmore Group and we could focus on what we're good at, which is the actual product, the investable offering. And then we'll let them handle more of the regulatory and compliance. And I think that is a tremendous model if that's a path you're thinking about going down. A question was dropped in the chat, so I think it's a worthwhile time to get to. Andrew, I'll direct this at you. While a Reg A is in process, can we also run a CF? Are we allowed to run both at the same time? And I'll just add one thing to that. Can you run a CF while you're waiting for your Reg A to be qualified?
Yeah, so it's a good question, and something that it sort of changed in the way the SEC looks at it. Sort of changed in the last year or so. A couple years ago, the SEC kind of adopted a rule to just trying to create clarity around this concept of integration, which is it's just an arcane securities law issue of basically says, all right, you can't use one offering in order to benefit another offering without both offerings complying with their requirements. And so the way the SEC has been looking at this lately is because of the way that rule is written, actually creates a scenario where it creates more conflict between CF and A than what we saw before. And the effect could be that if the SEC says, hey, your Reg A offering needs to be integrated with your CF offering, your Reg A offering is going to be limited to 5 million. So the same caps as if we were doing under a CF. In order to avoid that, for a first-time Reg A issuer, you can do a confidential filing. So while your Reg CF offering is ongoing, you're building that community, you're bringing in funds, you can file confidentially with the SEC. So that way you started that review process. You're working through the comments with the SEC, getting everything together, but but that information isn't yet public. Then once your CF offering is done, you've closed on your final dollars, you can make your first public Reg A filing. And then you've already cleared your SEC comments, and so you're sort of kind of on a glide path towards qualification there. So you're minimizing that downtime between raises in order to maximize sort of maximize the ad spend, keep everything fresh in the minds of prospective investors, and also then be able to lean into that community you've developed prior to and during the CF offering. It's things that trickier if you've already done a Reg A offering, because you can only do the confidential filing if you have not yet done a Reg A offering before. So so what that potentially requires is that you don't make a new public filing of Reg A until some time has passed after the close of your Reg CF. So the safe harbor is 30 days. But you could potentially do less than that, but it's kind of it's sort of in a gray area. But you would not be able to run both at the same time with under the way that the SEC is interpreting these integration rules. And and that gets a little bit different. And this is where kind of things are. There's not a lot of precedent here, so we don't. And also in a lot of these companies you're not going into this process with a massive legal budget. And we understand that at CrowdCheck. That's kind of why we've established our packages and our services the way we have. And if you're in the mood to kind of fight the SEC's interpretations, that's going to cost you just the time and effort of getting through that. While you may win in the end, sometimes it's easy. It may not be worth it as far as the cost and timeline involved.
100%. Stormer, coming over to you. As you're prepping and offering, there's obviously the legal and accounting, which we've already kind of hit on. There's also prepping the offering materials, right? The actual offering page, your marketing materials, and frankly, your marketing budget, right? Even if you have a great community and all of that, you're going to have to bolster it with a marketing budget and hopefully some marketing experts, whether they're on your team or agencies are working with. Talk to me a little bit about what all of that looks like in terms of putting all those materials together, all the things you need to have in place from a creative perspective. And then what is kind of a realistic, thought on marketing budgets to have in place when launching a Reg A?
Great question, and honestly challenging to answer because every offering is so unique. And again, when we're looking at like the two kind of scopes of issuers, there's the startup that's looking to raise their next round, their Series A, and then there's the perpetual fund marketplace. Both kind of two separate dichotomies, if you will. The marketplace, they should have a constant revolving marketing, process, creating awareness for what's to come or what's available. And again, if the CF is not available, there's always Regulation D that can allow capital to be ingested while the Reg A is being qualified. And something that we encourage, right, is that concurrent nature of having Reg D for the capital that's available and the Reg A for the retail audience. So what we see is like kind of building best in class, again, like building that team around you so that you can go to market with what works for you. We're at Dalmore, like we're a believer that, you have to pull in vendors, you have to pull in your team that's really specific to your type of offering, because a fund and marketing a marketplace is very, very different than marketing a startup or an early stage company. And so we've taken the approach of like integration. So allowing agencies, allowing marketing teams to integrate into our fundraising platform, connecting pixels, connecting that conversion pixel, Google Analytics, so that you can actually get that transparency when that offering or that opportunity is presented to the investor on social or LinkedIn perhaps. And that's kind of a gray box with going like the platform model, be it like a registered crowdfunding platform where you're sending your marketing dollars to another website, you're losing out on that conversion transparency. When leveraging a broker dealer for a Reg A, we go about it in a self-hosted, white labeled fashion. So you're sending your community, your marketing dollars to your website. So again, you're benefiting from a marketing perspective, just as you're hopefully benefiting from an investment perspective. I think it's important to build a funnel. We really look at fundraising as a systematic funnel. It's not spray and pray. It's really go strategic about who you're targeting, who is your niche and your audience, and then build that funnel. Like we really kind of look at fundraising as a blend of investment banking or financial service with e-commerce, building that checkout experience so conversion is really high for the investor. Most of investments on Reg A's happen on mobile. And so it needs to be friendly for investors. When they get that ad, they come to a landing page. That landing page is digestible. It, pitches the offering in a really tight fashion. And then, if they do move forward, that transaction process is seamless as well. So establishing a marketing budget is like really challenging, right? But I think at a high level, you should have a budget. And that should be, if you're going to deploy, tens of thousands of dollars into legal counsel and the process of a Reg A, I would look to have at least 50% of that in equivalent marketing dollars. And that doesn't have to be deployed in day one. That can be a slow burn over time. The idea here is you're warming up a community, you're finding your niche and your audience, and then you're retargeting so that eventually they get that comfortability, that brand recognition. And again, going back to like the institutions and the family offices that are looking at Regulation A, for them, it's the opportunity to become a brand name in the category that they're operating in, whether it's real estate or real estate development or alternative assets. Going out social is a very different model than raising from institutions and family offices. But when you start layering in marketing and Regulation A, now you can actually potentially become a brand name in the space for your vertical. And that's like so powerful, right? In that perpetual nature of raising funds. So Chris, I can't really hit you with a dollar amount, but you got to have a budget, you got to have a strategy, and you have to come to this with a game plan, right? Unless you have the strategy and the game plan. And I think that's what the team on this call, we excel at, I think, in my opinion.
Totally. And I would just say from my own experience, the larger the dollar sum, I think the more ambitious you have to be willing to be on your marketing budget, right? If you're trying to raise the full 75 million, I think ultimately you're probably going to come in somewhere around, and this is just from talking with different issuers. If this is a primary offering, the only offering you're doing for your one-off for your business, 10% of that, right? Which when you think about that in a dollar sum could be $7.5 million. But, you're probably doing that over 12 months, doing disbursements of your funding round. You're getting a lot of your investors to come in, but then you're redeploying to continue to invest in the round and bring in new folks as well. But you are going to have to invest in your round one way or another, whether it's from past things you've done or new things that you're doing, or preferably a combination thereof, if you really want to be successful.
And Chris, just to like maybe tag on that, like marketing is a use of proceeds as part of the offering, right? And so, you can use that kind of perpetual capital inflow as part of your marketing dollar. And then also, like, if you are putting 10% of your raise into something like a Reg A, that's marketing the business. That's bringing in new customers, new audience, new emails. Like, that's so powerful long term when you look at like the LTV of an investor. It's so much more powerful than that $1,000, $2,000, $5,000 investment that might come from that marketing spend.
And one other thing to say about that is typically, and please correct me if you have a different experience, Stormer, but typically when marketing and offering, about 60%, 50 to 60% of people who end up like following you will ultimately end up investing in your offering. And then the other 40 or 50% there, they kind of decide to follow, but they don't ultimately decide to invest. But with something like Dalmore Group, when they follow or they start that checkout process, but they don't finish, you capture their email and that becomes someone that's on your list. So even the folks who don't end up engaging and actually investing, there's still people that you can market your services to, who could become customers, who could become investors in the future. So I actually have, from when I did my Dalmore raise, like Dalmore did not invest in my CRM. And I have to tell you, several of them have ultimately invested in Kingscrowd longer term, some of them with fairly large checks. So it is not to say 100%. Because you acquired an email today that you didn't get anything from it. Actually, very different from that. I think you could end up getting a lot of long-term value. Continuing on the marketing discussion, I have another question here for Andrew. Andrew, can you highlight some of the key differences, if any, in terms of advertising and communication guidelines for a Reg A offering versus Reg CF?
Yeah, absolutely. So those are so definitely there are some similarities, especially in the way that they get used, and which is why sort of Reg CF or Reg A kind of sometimes get lumped together in the concept of crowdfunding, because you're using using online digital communications to reach a broad audience and bring them to your offering page to make the investment. So those are going to be, so those kind of, that principle sort of is the same between the two, especially when doing it in this format. But on the legal side, there's some slight differences. Reg CF, yeah, you have to use an online platform. Reg A, you technically don't have to, but if you're going for that large audience, that's going to be the way to do it, just because otherwise, just the logistics of bringing in sort of processing by hand $1,000 checks is just not going to work. But then on the marketing side, the sort of on for Reg CF, the kind of the principal rule we won't get into the details of kind of terms versus non-terms communications, which is something that is just a little bit of can get a little bit detailed and annoying. But the principal thing that the SEC wants in any of your off-platform communications is that you tell investors how to get to the offering page. Doesn't necessarily have to be an active hyperlink, but you tell investors how to do it. So that does allow for more sort of in real world marketing. So if you are if you're a restaurant, or if you have a product that you distribute that's distributed to consumers, you can it makes it easy to do something like using a QR code as a way to direct people to your offering page. So there's more opportunities there for engaging people in the real world, getting them to pull out their phones, using that QR code, getting to the offering page, and to be able to make an investment. And that so you're interacting with them and so they're engaging with you in person, and they can also engage with you sort of online to make that investment. Reg A is a little bit different in that it's for the communication. Anytime you're communicating beyond use of the offering circular, the SEC requires that you have already delivered the offering circular to those investors, or that the offering circular, or that you're providing investors access to the offering circular at the same time as the communication. So in practice, that gets a little bit trickier because once you go live with your Reg A offering, when you're doing that broad communications, it does sort of limit you to sort of more just digital only. You don't have that same opportunities for in person unless you have physical copies of your offering circular available, which we've advised companies to do. So they were they were a store with a countertop, and so customers come to the counter so they can say, hey, while you're buying our products at the same time, if you want to make an investment, here's our offering circular. So we advise them to have it there. And so at that point, you've delivered the offering circular. So now you can communicate and you can use any ways to direct those customers to the offering page. But with it just but definitely it works well with digital. You can have a hyperlink in your communications that takes them to the offering circular. One sort of kind of key, sort of kind of pushing the limit we've seen recently was Newsmax in their very successful offering, because they being a television network, they had a large audience that was there with them watching on television when they brought up those advertisements for their investment opportunity, and they were used a QR code for investors to take investors to the offering page. The SEC has never sort of explicitly endorsed or blessed the use of QR codes because you're sort of changing the format of the investors. The investor, they're seeing the advertisement on television, and now you're directing them to use their phone to get more information. Their principle has sort of been that they want investors to be interacting the same way with the detailed offering circular in the same way as they're getting that communication. But it's also something but the Newsmax show is kind of a low risk situation because the SEC has been aware of it, and they've been sort of slowly moving in that direction, just as general technology use has moved in that direction. That having that QR code is sort of the equivalent in some ways of a hyperlink, in that the access to that QR code is access and delivery, the same as access and delivery of the offering circular. So there's definitely some differences in the way that rules get applied, but in general, many of the concepts are going to be the same, especially in how you are developing the advertisements for the offering and what is done then to drive that investor interest to the offering page.
Stormer, question for you. Can you give us a couple of example Reg A issuers you've worked with? Maybe one on kind of just like the company side, raising money for their business, and then one on the fractional side, in terms of kind of like dollars raised, why you think they were successful, just to give us kind of a purview into what this all looks like.
Yeah, for sure. I mean, we've seen a wide range of offerings, like I said, whether it's like the equestrian horses with My Racehorse, and they're, predominantly using Regulation CF for some of their offerings. And then the perpetual type of fund, be it Arrived or Rally Road, for example. So Rally, extremely interesting, collectible marketplace. I think their most recent offering, or one of the more recent, was a massive dinosaur fossil, like one of the largest dinosaur fossils ever found. Super niche, super unique, but that is an alternative asset. And if we look at the history of dinosaur fossils, they tend to sell very, very high, and there's an appetite in a certain audience for those types of asset classes. So, to the tune of what they've, actually, raised, I don't know that exact dollar amount, but what we're looking at is like, millions of dollars going into these really unique alternative assets that are historically reserved for the 1% or the 0.01% of investor. Then there's the marketplaces that are offering like a fund, right? We have one issuer, they offer a bond, and they're preparing for their S1, right? So they've graduated from, doing Reg A, Reg D offerings, now moving towards a more public-facing offering via an S1. And that's been tremendously successful, right? Offering a yield of 8 to 12%, depending on the lockup schedule. And that model's been very successful for them because, we've been able to kind of design a strategy with their team, with their marketing team to build, a sales force around them that are licensed under the broker-dealer to help and support their sales function. So, many of the platforms that we support, they're raising multiple Reg As. But again, they're using it in a very strategic way where they've got the audience, they've got the marketing funnel, they have the investor appetite. And so, oftentimes I have founders come to us and say, okay, what does your audience look like down more? Like, what investors are you going to bring? And we treat our perspective a little differently in that our issuers own their investors. We don't go syndicate it, bring them to the next offering, very much keeping that white label in mind where the brand is the focus of the offering and you retain all of that data, all of that information. And so we keep things, fairly close to our chest in terms of how our issuer performance looks like, because it's their offering to tell, it's their story to tell. But what I can share is, over the last, 6 months or so, and definitely over the last year, we've seen anywhere from 50 to, close to $100 million a month being invested across these different regulations. And, we have seen a large appetite in Regulation D as well. Doesn't mean Regulation D cannot be considered, some form of raising capital from a crowd, right? There's plenty of Reg D investors, usually about 13% of households in the US. And, you can create a marketplace that allows those types of investors to participate. And so that's really where you're building that model, that strategy where you've got Reg D to complement the CF or the A so that you can really build this tight community of investors that can support in perpetuity. So I hope, that was a little long-winded answer, but, I hope that kind of paints the picture as to like how this model can work for certain types of companies as they look to scale.
Totally. What I would say is, listen, if you're a business or a serial issuer is going to be creating some sort of fractional platform or real estate fund or whatever it may be, and you have the ability, truly have the ability to raise, tens of millions of dollars, at least 10 million plus, and you're able to do that, annually or perpetually or whatever it may be, if you have that kind of horsepower in your system to do that, Regulation A is an incredibly powerful tool. You could continue to build your community, continue to build your customer base, all of those things. It is deeply, deeply valuable, and frankly can become one of the main mechanisms by which you grow your business, where you say, I don't need venture capital. I could just completely fund my business through Reg A, maybe CFs in the middle while I'm getting qualified for new Reg As, right? Like there is a path to do that. There absolutely is. People are figuring it out, and we're seeing more and more issuers who fit that profile, who figured out the mechanisms to do this on a pretty sustainable basis and continue to grow their business. It can be very powerful. On the flip side, I've seen many issuers who've made the mistake of going to Reg A far too early. And I will tell you, it's an intensive process not only to get to market, but then to keep yourself in compliance going forward once you've actually done your Reg A. So Andrew, let's talk a little bit about semi-annual report, your annual reporting requirements, all the things that you have to do to stay in good standing with your Reg A reporting going forward.
Yeah, very timely topic, as we just wrapped up, or just a couple days ago was the due date for semi-annual reports for calendar year, fiscal year companies. So as we kind of said at the beginning, Reg A is a mini IPO, and that's the term the SEC is using now to talk about it. And because there is ongoing reporting that goes along with the Reg A offering, and with that ongoing reporting, it does help then facilitate that trading market that Storm was talking about as well. That because those investors need to have current information about what's been happening in order to be able to price that trading round for secondary sales. So although it's so with a when you so for companies that are sort of fully reporting the exchange traded, it's a much heavier lift. You have those quarterly reports. You have much more significant reporting on your audit on for the audited financial statements with that PCOB accounting. A lot more certifications, things like that. So it's a really heavy lift. Reg A takes a step back from that. So not only is it fewer reports, you have your annual report that does require audit financial statements. So just your independent CPA can do your audit. Does not have to be PCAOB audit, but it does need to be audit financial statements for those annuals. And then semi-annual report with unaudited interim financial statements. So your 6-month financials. The annual report does also include lots of discussion about business and what you've been doing and sort of kind of giving those updates so that same, so providing a lot of the same information that was provided in the Reg A offering, but you're just cutting out anything that relates to a current offering because you don't have, it's not for a current offering, it's for just that, hey, here's the business update, here's what we've been doing, here are any sort of changes on our team, here's kind of the changes in ownership. Here's kind of the situation of what's been of any other securities that we've sold. And then here's our rundown of what's been happening on the financial side. So we're providing that context to the financial statements that are being provided. For the semi-annual report, it's just that financial discussion, the management discussion analysis that provides the context of the financial statements. So it's so the 1SA giving us a much smaller document than the 1K. But you also there potentially be times where a company would have to make sort of current reports as well. So these gets filed in the Form 1U. So if companies enter into sort of a new material agreement or terminated a material agreement that was previously in existence, that may trigger the requirement to file a Form 1U. So material agreements are being those that are very sort of things that are not just day-to-day business of the company. Like, hey, we've entered into this major contract that is going to generate, sort of 60% of our revenue going forward for the next 5 years. That's a material contract. It triggers our requirement to be filed. Also have filing requirements if you have a departure of certain executive officers. And then filing requirements, things like if you discover there was an issue on your previously provided financial statements, and so that you have to report that, hey, investors, you cannot rely on those. Also filing requirements if there's going to be a change in the auditing accountant. So it's whereas if you're a registered company, there are many, many more categories that would trigger reporting obligations. So is there something to bear in mind and something to prepare for? So we recently so kind of still wrapping up semi-annual reports with some companies because it's even though those interim financials, they're not audited, it still takes time to prepare. You have to get your books closed, prepare them, and so that way they're still reporting those results in accordance with generally accepted accounting principles. And so that takes time to prepare. And so then that's the first step before then preparing the report. For the annual reports for audit requirements, remember the due date is end of April. And accountants are usually pretty busy during April. And so for companies, when you pushing off those closing your books to get ready for the audit, you're going to be backed up with your accountants because they have so many other clients that are filing their taxes or doing other things. So it's important to get that to be prepared and do that early. So often in these reporting requirements, it's a good stepping stone. You're no longer a private company, so you still have these obligations. You have to make these public reports. And you have obligations to those investors that you brought that have given you money. But you're not yet to the level that you have to do all the things that are associated with being a public company.
And if I can also sorry,
oh yeah, please,
Chris,
please.
If I can also just add, and Andrew, correct me if I'm wrong, one thing that's like often not mentioned about Regulation A is the ability to actually extend it for up to 3 years. You can extend the offering, which can be advantageous if you're not filling up that full 75. So when we're thinking about reporting, if you're a marketplace and you don't fill up that full capacity, there is the option to extend the offering, for a period of time.
Right, absolutely, yeah, and that's one of the conditions. So a lot of companies will try to create a sort of a time limit on their offering to uh, generate that incentive of investors to get in now before the offering is closed. But you can't, but you can't just keep it open. And so it can be open for up to 3 years, so long as every year the company's filing an annual updating amendment. In the kind of 3 year period is sort of like that SEC is sort of put in the rule. It's basically like, we think after 3 years, your offering document is going to be pretty darn messy. So we want you to start from scratch at this point. But so long as you're current in your ongoing reports and do those annual updating amendments, you can keep an offering open for 3 years. And so that can be helpful for companies, especially because it's in one area where we see it actually being definitely helpful is state notice filings. That's often an overlooked part of that compliance process for a Reg A offering. States are able to, when doing the Tier 2 offering under Reg A, states cannot require you to be registered in that state, but they can still require that you provide a notice filing and you pay notice filing fees. And so those fees can add up. Some states it's fairly minimal, but there are some states that do have larger fees or fees that scale with the size of the offering. And so by doing an amendment rather than a new offering, that helps keep, because usually those amendment fees are less than new filing fees. And so that's a way to help offset some of the costs. And so long as you're able to effectively utilize that amendment process in your kind of and to keep your offering open. But if you need to rely on the, hey, we're closing this offering as part of your marketing effort, then if you say you're going to close, you have to close.
Right.
Awesome. Well, as we kind of wrap up here, Stormer, Andrew, if folks are interested in learning more, they're saying, hey, I think Reg A can make sense for me. I think this is a path I want to go down. Stormer, where should they go? What should they do?
Yeah, I mean, I always say start the conversation as early as possible. The broker dealer, like us at Dalmore Group, you can find us dalmoregroup.com. Have that conversation with us because we can help kind of navigate where to go from there. Oftentimes, the next conversation, legal counsel to address the security that's being sold. Another kind of caveat is, a lot of platforms will start building their technology before they even think about the regulation that they're selling. I'd be cautious of that. Once the broker dealer becomes involved, we have to review, approve everything, making sure it's compliant. That's where we have a white labeled solution that works for all different types of regulations and offerings, and could be a helpful fit. So happy to have a conversation, happy to be a resource, especially as issuers kind of navigate their funding path across all the exemptions.
Awesome. And Andrew?
Yeah, absolutely. I go to crowdcheck.com. We're open to talking to anybody just to like kind of figure out if there's a fit. Does this sort of structure work for the company, what they're trying to do and trying to achieve? If Reg CF or Reg A is available, is something that is worthwhile for them or something they want to consider. And a lot of times we may say, it's maybe not. And if we kind of if you're not used to or not being willing to put lots of information out publicly, it may not be the right fit. But we're definitely happy to have those conversations and kind of get cover a little bit of that ground of what are those key considerations for the company situation.
Well, one of my favorite things about CrowdCheck and that I've always loved is that you pretty much provide a fully baked price up front of what it costs to get your Reg A to qualification or through qualification. Listen, you don't have to use CrowdCheck, but all I will say is be careful going to these large law firms that have only maybe done a handful, if any, Reg A's before, and your bill could get into the hundreds and hundreds of thousands of dollars. I've heard far too many horror stories of people who end up with $300,000-$400,000 bills and end up only raising a couple $1 million anyway and go, what did I just do? Knowing what your fully baked price is, that's very affordable compared to anyone else I've ever seen in the market. Definitely at least consider chatting with the CrowdCheck team. But again, just be careful about going to really large firms. Second thing I'd say is I think Stormer and the Dalmore team, they have been in the Reg A space for as long as anybody, probably one of the longest standing, if not the longest standing broker dealers in the space, really know what they're doing. I've worked with them before. They have a phenomenal team, and they have worked with a ton of Reg A's and some of these biggest serial issuers. I have a lot of respect for what they've done. If you're, as both of these guys have said on this call, if you're looking to do a successful Reg A and set yourself up for success, bring in great partners, work with great people. You definitely can't go wrong with the folks on this call, and really appreciated having them on the call today, and for all of your insights that you've been able to share with us. So Stormer, Andrew, thank you so much for being with us today.
Absolutely. Thanks, Chris.
And
Likewise,
last
Chris.
thing before we hop off, Chris Roach, thank you for joining us for the entire session. We will be reaching out. We do have your email and contact info, but congrats. You got the 3-month King's Crowd Edge giveaway. So excited to send that your way. Thank you, everyone, for listening in, and